Hi, I'm Ruban Selvanayagam, co-director of Property Solvers, which I run with my long-term business partner, James Durr. I first got involved in buy-to-let back in 2006. James started even earlier in 2003. Since then, we've watched the market move through the pre-crash boom, the 2008 fallout, the recovery years, the introduction of Section 24, increasing regulation and licensing, rising mortgage rates, alongside higher running costs across the board. More recently, we've seen the Renters' Rights Act come into play alongside the rapid growth of institutional build-to-rent operators in many of the larger towns and cities. So when people ask, is buy-to-let still worth it? A no response makes some sense, because the answer isn't as straightforward as it used to be. Let's get into it. When James and I first started, buy-to-let certainly wasn't effortless, but the fundamentals were clearer. You still had to source good deals, manage tenants, and maintain the properties, but the numbers were more forgiving. Mortgage rates were lower, tax relief was far more favourable, regulation was lighter, and in most areas, capital values moved steadily enough that you could build equity without needing to force it. Now, it wasn't a guaranteed win, but it was noticeably more predictable and far less restrictive compared to the landscape that eventually developed. Fast forward to today, and the tax position is tougher, regulation has widened, tenant protection has increased, and the frictional costs of operating as a landlord, from borrowing to compliance, is noticeably higher. In many of the large towns and cities, institutional build-to-rent operators have also raised expectations around quality and service. All of this means that buy-to-let is no longer something you could treat as passive or hands-off. The model has fundamentally changed, and understanding how it has shifted is essential. Before Section 24, individual landlords could deduct all mortgage interest from rental income, which is the standard tax treatment for finance costs in most other businesses. It meant that portfolios with higher borrowing levels could still remain tax efficient, particularly in high-value markets where yields were naturally lower. When that relief was removed and replaced with a flat 20% tax credit, everything changed. Many landlords were pushed into higher tax brackets, and previously profitable properties suddenly fell into break-even or negative cash flow once tax was factored in. That's why a significant number of landlords sold up rather than try to absorb the pressure. And for those considering restructuring, moving existing properties into a limited company wasn't the easy fix that many had hoped for. It typically triggers both stamp duty and capital gains tax. A number of schemes claim to offer a workaround, but most have since collapsed, and in some cases attracted HMRC investigations, as highlighted by tax experts like Dan Needle, the former head of tax at Clifford Chance, who now exposes aggressive and non-compliant tax schemes. For new purchases, many landlords, ourselves included, now use limited company structures to regain mortgage interest deductibility and approach property with a more business-like mindset. But even then, incorporation isn't something to follow without any thought. It only works when it's backed by proper tax advice, a long-term strategy, and a clear understanding that company borrowing and running costs are usually higher. At the same time, the cost of borrowing has reshaped buy-to-let more than almost anything else. The days of 2 and 3% fixed-rate mortgages are effectively gone. Stress tests are tougher, loan-to-value limits are tighter, and many mortgage applications now rely on top slicing, where outside income is used to satisfy affordability. All of this puts net yield front and centre. A deal that worked comfortably at 80% loan-to-value 5 or 6 years ago may not stack at 75% today. The investors still active in this market are the ones who've adjusted to that reality, targeting stronger cash-flowing stock, negotiating deeper discounts, and approaching every acquisition with far more discipline than was needed a decade ago. Another major and somewhat related factor is the growing pressure around EPC ratings and long-term net zero requirements. The old EPCC deadlines were removed, but everything coming out of the government points to tighter energy efficiency expectations in the years ahead. Older properties, Victorian terraces, pre-war homes, and flats with poor insulation or electric-only heating face higher upgrade costs over the medium term. Even without legislation, buy-to-let mortgage lenders, insurers, and tenants are already favouring more energy-efficient homes. For long-term investors, planning for heating upgrades, insulation improvements, and general thermal efficiency is essential. These costs don't make buy-to-let unviable, but they do make it more capital intensive. At the same time, the broader regulatory environment has tightened significantly. The Renters' Rights Act has raised compliance expectations, increased documentation requirements, and shifted far more responsibility onto landlords, and the impact is clear. Recent National Residential Landlord Association surveys throughout 2025 show a sustained rise in landlords planning to sell or scale back their portfolios, with smaller landlords in particular citing regulatory pressure and the lack of financial viability as key factors. Alongside all this, institutional landlords in the build-to-rent sector have expanded rapidly. Pension funds, insurers, and major investment managers are now developing large rental blocks in places like London, Manchester, Birmingham, and Leeds. These schemes offer on-site management, amenities, and a level of service difficult for smaller landlords to replicate. They also operate on long-term, lower-yield horizons. But it's important to be clear, institutional investment is heavily concentrated in large urban centres. It's not targeting suburban terraces or semi-detached houses, ex-council flats, traditional family homes, small HMOs, or regional town markets. Smaller landlords in most parts of the UK aren't competing with these operators at all. What institutional growth really signals is that rental demand is robust, that the premium end of the market in major cities is becoming more competitive. When you put all these elements together, a clear theme emerges. Buy-to-let has become more demanding and more professional. The days of set and forget landlording are largely over. Modern investors need to stay on top of compliance, manage tighter margins, plan refurbishments in advance, keep an eye on tax changes, and think strategically about tenants, costs, and financing. None of this should put investors off, but the people who succeed in today's market are the ones who treat property as a proper business rather than a passive side income. And while short term pressures are real, UK property has historically rewarded patience. For those who think in decades rather than years, that remains a compelling reason to stay in the game. So, where does buy to let still work well? It remains extremely effective when the fundamentals are strong. High yielding regional markets, particularly in the Midlands and the North, continue to offer strong returns because acquisition prices are lower and the tenant demand is consistent. Properties that can be improved, refurbished, or reconfigured allow investors to create equity far more quickly than relying solely on natural capital growth. And niche strategies, well managed HMOs, student rentals, social housing leases, commercial to residential conversions, can outperform standard single lets when approached correctly. Auction purchases and off market opportunities, including motivated sellers, probate cases, and distressed stock, can provide the kind of margin needed to offset today's higher costs. And with many landlords selling up and inflation adjusted prices softening house prices across much of the UK, there are genuinely attractive opportunities emerging for investors who know what they're looking for. This is exactly where the Property Solvers model fits. Our auction pipeline and direct to vendor campaigns often give investors access to properties that simply wouldn't stack up a full asking price on the open market. Indeed, a property bought below market value is naturally more resilient to taxation, interest rate rises, and compliance costs than one bought at retail levels. So, looking ahead, regulation will continue to evolve and landlords will remain under political scrutiny. Minimum standards will rise, tenants' rights will expand, environmental requirements will tighten. But none of this signals the end of buy to let. The private rented sector is essential to the UK housing system, and it isn't going anywhere. What it does mean is that the bar is being raised. Investors who approach the sector casually may struggle, whilst those who build systems, run their numbers properly, and focus on strong fundamentals will continue to do well. So is buy to let still worth it? In our view, yes, but not in the easy hands off way it once was. The model is still profitable, but far more selective. It's still viable, but far more regulated. And the opportunity is still attractive, but it demands more effort. The investors who thrive today buy well, manage actively, understand the detail behind net yield and sensible gearing, and adapt to an ever shifting landscape. And that's really the aim of this new channel, to look at property investing more broadly and share the kind of practical experience led insight that helps serious investors make better decisions throughout their investment journey. A big thanks for watching to the end.